In this presentation, we will discuss student loan interest as an adjustment for AGI. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Student loan interest payments are, of course, part of the payments that we make on the student loan. So we take out a student loan, and then at some future point, we have to make payments on that loan. The interest that we have to be charged, that we have to pay for that loan, is the amount that we're thinking about here. We may get a deduction for as an adjustment to income and above the line deduction. In order to qualify, student loan interest must be for a qualified student loan incurred by a taxpayer to pay qualified education expenses incurred on behalf of the taxpayer, taxpayer's spouse, or any dependent of the taxpayer at the time the loan was incurred, up to $2,500. So then the question is, what is qualified education expenses? So the loan has to be for qualified education expenses. What are those? As we go through the qualified educational expenses, remember what we're thinking of. We're thinking about deducting the interest that we're paying on the loan payments that we're paying back. As we do so, we need to consider, what did we take the original loan out for? We had to take it out for us to pay for qualified educational expenses, those being costs of attendance at an eligible educational institutions. Includes things like, of course, the tuition to that institution. That's going to be the most common type of thing that we'll think of. Well, of course, the tuition costs will be included in qualified educational expenses, but also fees, books, supplies, equipment, room and board, transportation, and other necessary expenses. Notice what is missing from this list is meals. Meals is typically not included as qualified educational expenses. Must be paid or incurred within a reasonable period before or after the loan date. The course of study can be either undergraduate or graduate study. Student loan interest limitations. So there's going to be a limitation on the deductibility of student loan interest. And as with many limitations, it has to do with the amount of income we have. So we usually have that limitation, these type of phase-out type of limitations on adjusted gross income in some way. Oftentimes we need to make some type of adjustment to the adjusted gross income. So you want to know kind of the standard rule, how to apply it, and then we'll get into a little bit more of the details. In essence, if you have a lower income and you're paying back student loans, you're more likely to be able to get to the deduction. As your income rises, as we earn more, it's less likely that we're going to be able to deduct the student loan interest. The actual calculation is on adjusted gross income, kind of, but we're going to have to modify it. Adjusted gross income modified. How do we modify it? Well, we start with the adjusted gross income. We make adjustments including any deductions for student loan interest. So we're obviously not going to include student loan interest in the calculations to see if we qualify for student loan interest. And then we have to say the foreign U.S. Possession or Puerto Rico income exclusion from taxable income will be added back. We'll also add deductions taken for tuition and fees. So we'll add that back into the adjusted gross income if applicable. Deductions taken with regard to domestic activities production. So these are going to be items that we'll have to adjust for adjusted gross income for this particular type of calculation to consider the phase-outs as AGI increases. So the limitations continued. Student loan interest is reduced when modified adjusted gross income, so basically how much money we earn, how much money we're getting, is greater than $135,000 for married filing joint. So if we start to get our income for married filing joint, two individuals, that's above that 135, then the amount that we're deducting on the student loan interest is likely to phase out and start to go away. 65,000 for individuals. So for filing status as single, 65,000. Student loan interest is eliminated. So now the question is, when does it go away entirely? And it'll go away entirely at 165,000 married filing joint and 80,000 for single. So we won't get into the calculation of what the phase out will be. Just note for now, for the simplified kind of how to apply this, if your income is below these levels, you should be more likely to be able to take the student loan interest that you pay as you repay the loan. As your income goes up over these levels, then you're more likely not to get any benefit. And in between those two, you're likely to get some benefit, and it's going to have some type of phase out that will be calculated on it. We'll look at some examples of that in later presentations, what the phase out might look like in terms of just doing some scenarios within tax software. This is going to be a 1099-E student loan interest statement. So most of the time when we're in a qualified institution, when we start paying back the student loans, we don't really have to dig up how much of the loan is interest or not. We should get a statement from it for our taxes to tell us how much of our payments were for interest. This will then be our starting point to take, we know how much interest we paid now, in other words, and now we have to see if we qualify or not, taking this data, putting it into the system, and applying the rules. For more accounting information and accounting courses, visit our website at accountinginstruction.info.